Yes.
So going back to Shubham's point about descriptive analytics, then he talked about predictive analytics. We predict the trends, but then we take it a step further to prescriptive analytics. We prescribe the course of action based on the predictive analytics we perform in step two. Very often we must go to the seminar, to some program, and we gain some valuable information. And we start confusing knowledge information with the application of information. It's called illusion of knowledge. So we also have such dictums as knowledge is power, but that's not really true, because knowledge plus action are power.
Yes.
But if we just acquire knowledge, we are fooling ourselves that we know something and as if we already implemented. But the true experiential knowledge comes only from putting it into practice, to helping other companies, going through some actual case studies, so that we can talk from experience, not only from theory. Because if we talk only from theory, we can be false shepherds, and but there is no shortage of money on this planet, but there is a shortage of value adding activities.
Yes.
So if we don't produce value added activities, money wouldn't be trickling in. But if we do produce value, we'll inevitably get money. It goes back to start with the end in mind. If I don't know where I'm going, where I would like to go, I am groping in darkness.
Yeah.
I am aimless. So why businesses consider M&A and corporate restructuring? We can see several considerations here, so such as strategic growth, market expansion, synergies, diversification, innovation, and technology. So from the strategic growth angle, we can consider such aspects such as expanding market share and reach, accessing new customer segments and geographies. From market expansion perspective, the advantages of merger or acquisition can be entering new markets quickly, because there is already presence there. So, for example, I worked for a German firm, for a German-owned CPA firm before, and they really wanted access to the US market, but they didn't want to start from scratch. So what they decided to do was to partner with the firm in Atlanta that has been in CPA business for 2 decades, and they merged with that firm, and they became 51% owner. So that was an example of the merger where the German firm obtained access to the market without having to start from the scratch. Then synergies. It's combining resources for cost savings or enhanced operational efficiency. So like perhaps another company has better automation systems and processes. Then diversification, reducing dependency on a single market and spreading risk across different sectors. And it goes back to the avoiding risk of concentration. So at the amoeba level, we can see that with the concentration of customers or concentration of vendors, that can put company at risk. And at more macro level, we can see it. We can see it, the business being limited to just one jurisdiction and to one sector, and merger can help the firm gain the access to multiple jurisdictions and markets, and spread across different sectors. From innovation and technology perspective, it's acquiring cutting edge technology or accelerating innovation efforts. Benefits of M&A and corporate restructuring. One of them is gaining economies of scale lowering cost of shared resources, and increased purchasing power. Then we can talk about increased revenue, access to new revenue streams, and cross-selling opportunities. Another advantage is enhanced competitiveness, strengthening market position and outperforming competitors. Then here's a good one, talent acquisition. Because if you talk about global merger and we gain access to diverse opinions and perspectives. So if we talk about our company being the bee dance, so what comes to mind first? Cross-pollination, cross-pollination, because the bee has to fly to another flower and pollinate the flower. That's how we have abundant crops eventually. Because then she takes some of that pollen and puts it in another flower. That's what called cross-pollination. Well, we use the same terms about cross-pollination, ideas, and perspectives. And if we just marinating one company culture, it can lead to groupthink. But if we move to another company and merge with another company, it can break through that groupthink. And especially so when we are moving to different jurisdictions and different global markets. Then we have risk mitigation through diversifying business risks and navigating market fluctuations. Because if one market is in recession, another market can be doing better. Potential challenges of M&A and corporate restructuring. We can name a few benefits, such as cultural integration, merging different companies' cultures, employee resistance, because they are used to the current status quo and they don't want to change anything. Then another challenge can be financial risks. There is a tendency to overestimate synergies, and then there is a debt burden, either from the target company or from the debt needed to finance the transaction itself. Operational disruptions, integration challenges, and disrupted workflows. Another challenge of M&A transactions can be regulatory hurdles. So compliance with various regulations in different jurisdictions and antitrust scrutiny. Because if there is a bigger piece of the market acquired, of the bigger piece of the market share acquired as a result of the M&A transaction, then the antitrust, anti-monopoly laws can kick in depending on how much market share is acquired. Stakeholder concerns. We can name shareholder uncertainty and customer and partner apprehensions. Consequences of hiring an inadequate due diligence firm. One of them is incomplete information. A bad due diligence firm might fail to uncover crucial information about the target company, such as hidden liabilities, pending legal issues, or problematic financial data. This incomplete information can lead to uninformed decisions and potential legal or financial troubles down the line. Missed opportunities. Inadequate due diligence might result in overlooking potential synergies, cost-saving opportunities, or growth prospects that could have been identified and leveraged with a more thorough examination of the target company's operations. Financial risk. A poor due diligence process might not adequately assess the financial health of the target company, leading to inaccurate financial projections and an underestimation of the financial risks involved in the merger acquisition. Then reputational damage. If the due diligence firm fails to identify ethical compliance issues within the target company, the acquiring company's reputation could be tarnished by association with those issues post-acquisition. Legal and regulatory issues. Inadequate due diligence might lead to overlooking legal regulatory compliance concerns, resulting in potential fines, lawsuits, or even the nullification of the deal due to legal issues. Integration challenges. Without a comprehensive understanding of the target's company operations, culture, and processes, integrating the two entities after the merger acquisition can become complicated and less successful. So you see in this point here, the deal may not even go through because of the legal issues. In this case, the deal did go through, but there are significant hurdles and integration challenges. Then we have valuation errors. If the due diligence firm misses key financial operational data, it can lead to inaccurate valuation assessments, potentially resulting in overpayment for the target company or undervaluation of its assets. The way the M&A deals work is that when you value a company, it's usually a multiple of EBITDA, earnings before interest, tax, depreciation, and amortization. So basically, multiple of profit. So if the due diligence team and doesn't appraise, doesn't ensure the integrity of the financial information, then there is a possibility that the profit was calculated incorrectly. If the profit was calculated incorrectly, then the multiple was applied. Then when we apply a multiple for professional services, it's 1 to 2 times of profit, then the whole value of the company would be wrong. Unforeseen costs. Hidden liabilities or unexpected operational challenges discovered post-acquisition due to poor due diligence can lead to unanticipated costs impacting the financial performance of the acquiring company. Employee morale and retention. Failure to assess the target company's organizational culture and employee satisfaction can result in post-deal employee morale issues and higher turnover rates, hampering the integration process. And if there are higher turnover rates, it will also affect the unemployment rate, because the higher the turnover rate, and then there are more unemployment claims, then it will affect the unemployment rate this company pays to the federal and state governments. Strategic misalignment. A lack of proper due diligence may result in a misalignment between the acquiring company's strategic goals and the actual capabilities and potential of the target company, leading to suboptimal post-acquisition performance. Wasted resources. Engaging a bad due diligence firm can result in wasted time, effort, and resources on a flawed assessment process, diverting attention from other critical aspects of the merger or acquisition. Diminished competitive advantage. Inaccurate and incomplete due diligence can hinder the acquiring company's ability to capitalize on its competitive advantage, impacting its position on the market and potentially leading to missed growth opportunities. So imagine we talk about the merger of 2 healthcare companies, and one of them was hoping to acquire another healthcare company with much better IT capabilities. So then the merger happened, and we go through the integration of IT systems, but something went seriously amiss in the process, and that integration of IT capabilities is not working. So then it impacts work with the customers. It impacts the ability of the company to generate revenue. And I witnessed the case where the company invested 20,000 plus, north of 20,000 on acquisition of the new software for healthcare. but because of the inherent issues of implementation of integration of the software, it nearly went bankrupt just because of the software integration issues. Financing investment issues. If the due diligence process fails to provide a clear picture of the target company's financial situation, it can create difficulties in securing financing and attracting investors for the deal. Because if the lenders have doubt about the company's financial health, then they wouldn't want to loan money for the transaction if they have doubt as to the company's financial health. Long-term performance. Inadequate due diligence can contribute to poor post-acquisition performance, as issues that were not properly evaluated during due diligence may emerge and negatively impact the merged entity's operations. So think about it as an iceberg. So if you have an iceberg and only 1/8 of an iceberg is above water, due diligence team has limited time to assess the company. So how do we do it? Sampling basis. We have to sample. We have to get enough sampling for the company to form an assessment of the entire iceberg, or the other 8/9 of that iceberg. So if the company didn't use proper samples for assessing the transactions and the internal controls, systems, processes, and procedures, then that 8/9 of the iceberg hidden underwater will be misassessed. And if it is misassessed, then the new company, the new emerging company, will have serious surprises along the way. Exit strategy challenges. Flaws in due diligence can make it harder to exit the investment if needed, as potential buyers or partners will be concerned about the same issues that were missed in the initial due diligence process. So it causes ripple effects if then that new company would want to exit, and then there was a lot of messiness and issues. Then by the time they get to the point of wanting to sell themselves, they would be at a serious disadvantage. There is a case of a defunct brewery in Brooklyn that went bankrupt because they hired an incompetent due diligence firm. And that case is actually showcased at New York Museum of Finance in the Wall Street area. So you can go there and it's actually posted on the wall. That because of the bad accounting advice, this brewery went bankrupt. You need a blueprint, not just a checklist when it comes to your value creation. Because you see, and we emphasize value creation because we take our clients through the entire value cycle, starting with tax resolution. If the company finds itself in a tax resolution situation, and then we provide funding through tax credits, and we empower business owners through color accounting, and then we provide financial, like CFO, outsource CFO services by guiding companies through ratios and key performance indicators. We help them build value month in and month out. And we help with financing so that by the time the company does get to exit and wants to merge with another company or franchise, if we did all the previous steps right, it would lead to the company would have enough value to sell at a higher range of multiple of EBITDA or profit multiple. So here's the success blueprint. First, keep tax, financial, and legal teams engaged in planning from the beginning. You see, it's a multidisciplinary approach. Tax considerations, financial considerations, and legal teams. because some CFOs or outsourced CFOs focus only on the financial measurements, but not so much on tax planning or legal considerations. So it's good to have a multidisciplinary team that can assess tax, financial, and legal considerations of the deal. Then second, start with the clear M&A strategy. It goes back to 7 principles of highly successful people. And principle number 2 says, start with the end in mind. What are you trying to achieve? Why do we need this deal? Maybe this company would be better off without merging in the first place. So the question is, do we have true augmentation of competitive advantages in mind that would justify the deal? Maybe we're just wasting resources with the misguided notion that that deal would be helpful, but actually it would be detrimental in the long run. And third, focus on value creation. And you see, again, if you focus on value creation, because in color accounting that we offer, it's all about learning value creation cycle. There are 2 sides. The one in green is uses of funds, and the one in orange is sources of funds. And we have 3 sources of funds, actually 4, but in that system 3. Let me mention 3 first. It's funds from banks or lenders, and then sources from owners and investors, and then finally sources from revenue, it's called generated equity. But there is the 4th source, think government. That's the sources from the government through the tax credits. If the company opens in the economically disadvantaged zones or hires people with limited access to the labor market, the company can get credits from the government and cash infusions from the government. So that's the 4th source of funds. So that's the orange side, sources of funds. Then the green side is uses of funds. That's assets and expenses. So the idea is to build the company's assets, and assets minus liabilities is company's equity. So the idea is to increase the company's assets or build long-term value for the client. So you see, we're focusing on value creation, that with each service we provide, we build incremental value for the client, so that when they do reach the exit point, they can sell at the higher range of EBITDA or profit multiple, not at the lower range. 4th, do comprehensive due diligence. Comprehensive ties with point number 1. You see, it's a due diligence process is multidisciplinary approach. It involves tax, financial, legal, HR, IT, environmental considerations. It's a multidisciplinary approach to assessing the company. And as I said at the outset, it's like an iceberg. Only 1/8 of the iceberg is visible. So if you simply read financial statements, it's 1/8 of the iceberg, because there is a lot of information that's not included in the financial statements. It's called qualitative aspects of accounting information. We have to gain a much broader assessment in the field for the company in order to get into the eighth, ninth of the company that's not visible. And the only way to do that is to hire a highly competent, multidisciplinary team, considering tax, legal, financial, IT, HR, environmental, and other considerations. 5th, be a ready buyer and seller. That goes back to Covey's principle number 2, start with the end in mind. If we want to sell, we must start building value now, because once we get to the exit point, we must have good value proposition for the acquiring company, that the acquiring company would be interested in buying our target company. Then 6th, devote more resources to integration. And it goes back to that example about IT integration. And I mentioned that one healthcare firm nearly went bankrupt because it invested heavily in the new software, but the integration and implementation was so poor, it nearly it 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 nearly made the very viable healthcare company bankrupt because of the serious IT implementation issue. So sometimes we may want to make things better, but if the implementation doesn't go right, if the logistics are not worked out, we can fail miserably. Shubham and I were talking about the war in Ukraine the other day.
Yes.
And we were talking about logistics, and we were discussing that Russia cannot win that war in Ukraine because it's a very big country, and Russia's most serious challenge is logistics because they're running out of fuel, they're running out of ammunition, and they cannot supply it quickly enough because of the sheer breadth of Ukrainian territory, and Ukrainian soldiers are not letting them get access to those points where they can get the resupply of their ammunition, fuel, and so on. So in the war situation, it's very much about logistics and about the access points to resupply. So in the situation of the company, if the company can have great abstract ideas, oh, we are going to have this great access to the global markets. We're gonna build this perfect synergy. So a lot of buzzwords and abstract ideas, but if we don't like roll out the sleeves and take care of the logistics and the actual implementation, that we can waste resources in the merger, and perhaps we had to borrow the funds from the bank. We had to borrow it, and we didn't roll up the sleeves and taking care of the logistics. Then that new company would go bankrupt. So the owners of the company find themselves in the hole. And if in the bankruptcy process, the court would pierce the corporate veil, then they can go after the personal assets of the owners. So they can find themselves in very serious trouble. And if the company was in the financial services and FDIC insured, they can be disbarred from practicing any financial services, period, for the rest of their lives. So not only their assets can be depleted, both company and personal, their careers can be ruined. So you see, it's sometimes people have misguided notions of talking about these buzzwords, synergies, or global markets, and they're using these buzzwords. But I want to reiterate, the same thing is about war in Ukraine. The key point is logistics, making sure that the access to resupply is open, that integrations are done properly. If we don't take care of the tactics, then strategy could be great, but because of the wrong implementation and tactics, the whole thing gets unraveled and goes bust. And then seventh, focus on people. It's
I think it's more about cultural integration and being considerate about cultural integration when going through with mergers and acquisitions. So yes, it is very important because not a lot of companies account for this in terms of statistics. About 87% companies, 87 companies who face failure in terms of mergers and acquisitions have said that they prioritized the focus on people or cultural integration. Their focus on it was not what it needed to be.
Yeah, because say there is if we talk about the Kashmir region in India and
Yeah,
Indian-Pakistani conflict, and imagine somebody goes to that Kashmir region to like work with the people there and closing some deal, but if the person doesn't have local consultants and guides to guide them to navigate through subtleties of the process, very tricky situation, and things can go seriously wrong because things are already explosive in that region politically. And I'm not saying that a lot of people want to set up business there because of that conflict, but I'm saying that one company can employ people from Pakistan, another from India. And if these cultural considerations are not taken into account, it can result in a lot of friction between emerging companies, which is a result of the merger of two companies.
Yes, I mean, in terms of this geopolitical scenario, I would say that the people of Kashmir, I think they want advancement. That's their by also respecting their culture, their traditions, but still prioritizing development. And that's what the government of India is doing now. And prior to that, there were a lot of communal accidents, I would call them communal accidents, by parties who did not intend to actually solve anything. So it's very important to be considerate of people's traditions and values, and because that is something that will help you or aid you in developing that specific region, and in our terms, its function, improving our processes and controls. And yes,
Yeah, so and Shubha mentioned community processes. When we return to the concept of the bee dance, there is a book called The Bee Democracy, and it really discusses the topics of how communal bees are. Even think about the whole process. The bee goes to discover the source of honey. She comes back, does a wiggle dance to indicate the source of honey for the other bees because it's concerned about the well-being of the bee community.
yes,
So if we have like a truly local focus, and then somebody comes up with the great idea of some merger and acquisition, then it depends on this, it depends on the scale. The mergers and acquisitions I participated in were more on the mid market side. So the biggest one I participated in due diligence processes had to do with 150 million sale of 13 assisted living homes. But if we talk about really big ones, then there are a lot of people involved, and those people live in certain communities. So if the new company does go bankrupt, we must think of the effect it will make on the communities that those people belong to. And that's all because sometimes we want to be too conceptual. And it's good to have a conceptual roadmap, but it's equally important to have the logistics and tactics in place to make sure that strategy will really work. Therefore, we need a multidisciplinary approach, all hands on board, advisors working very closely with the company management, the company people, in order to ensure that the logistics and tactics are not neglected. And I cannot overemphasize this point enough. Why work with us? When we help clients, we really focus on the entire value creation cycle through comprehensive integrated services. So we offer tax expertise, tax resolution in case of pre-existing tax liability, because I did see deals where the deal was about to go through, but then it became known that the target had some tax resolution situation, meaning that the company was under audit and had some unresolved taxes.
mm,
So since it emerged eventually, it was quite a surprise for acquiring company, and that issue had to be settled immediately, so that the target company paid that liability first, and then decided to go through the tax courts to still make a case about getting some of that money back from the IRS. But for the sake of the deal, in order for the deal to go through, it had to resolve that tax situation, because otherwise the deal wouldn't go through. So that's where tax resolution comes in the context of due diligence.
I mean, recently also you were talking about a lot of firms who have assets here in Brooklyn and Manhattan that have that had BSA loans issued to them a few years ago, and they were facing. I mean, now that they have actually finished those funds, now the government requires explanation of how those funds were used.
The government is auditing them.
Yeah, they're auditing them. So, I mean, they are now facing, since they did not, of course, most of the firms actually do not take care of their financial regulations.
Yeah.
Only when the time comes, such as an activity such as an audit,
That's right.
that's when things become difficult. So in these times, I think it's very important to for a professional, tax professional, who is competitive and to come into the picture and actually help them and negotiate with the IRS on their behalf.
Yeah, so when we talk about we talk about contingent liabilities, we talk about any pending litigation or any ongoing processes. Shubham is right. It's not just unresolved tax disputes, which we definitely have to attend to that.
Yeah.
But it's also any SBA audits for any help that the companies receive from PPP or from Restaurant Revitalization Fund or from idle loans. If they were not eligible for those funds, then the government is auditing them, then there is a serious risk they will have to repay either part or the entire loan. So risks and contingent liabilities like that have to be disclosed, because otherwise target company is misleading the acquiring company as to the true situation of its financial health.
Yeah.
Then we provide financial planning and advisory, financial planning and analysis or outsource CFO services. That's when we guide the company month in and month out on the internal controls, on the which is systems, policies, and procedures, establishing the right ones for the company. And we help them with financial metrics and ratios. And but not only that, but we also incorporate tax considerations, because a lot of clients come to us at the end of the year and they say, do something about our taxes. But that's too late. It's at the end of the year. The planning has to happen all along. Again, let's take care of the logistics, the fundamental taxes throughout the year. Because strategically, in my mind, we can say, oh, that's fine, I'll take care of that by at the end of the year. At the end of the year may be too late. So we take a proactive value creation approach and we help them manage their finances and plan their tax strategies month in and month out. So by the time they do get to exit options, they build enough value that they can sell at the higher range of multiple, not at the lower range of profit or EBITDA.
I think you should surmise us with the story about the guy who converted his company from 2 million to about, I think his EBITDA was 77 times when he sold. Yeah.
Oh, yes, I'm glad you mentioned that. So when we talk about multiples, so when the companies are being sold, usually it's at the multiple of EBITDA. So EBITDA is earnings before interest, taxes, depreciation, amortization. So simply speaking, it's like modified measure of profit. So basically, to make it super simplify, let's say it's profit.
Yeah.
It's a multiple of the company's profit. So usually the companies, different industries have a different multiple. So hospice company can sell between 5 to 7 times the annual profit. The professional services firm can sell between 1 to 2 times profit. That will be the value of the price for the company. What do you think was the highest multiple in history that somebody sold his company at?
I mean, you said that the higher range was with the hospice care, so, and you said it was about 1 to 7 multiple of EBITDA, so I would say
For like it's like
about 8, 9, maybe.
No, it's actually much more. The highest multiple of profit was 77 times. And 77 times, and it was by this guy, Bronson. It's by Brandon Dawson. So Brandon Dawson sold his company Odygy at 77 times the profit. So his company's profit was about 2 million per year, and he sold it at 150 million. So 77 times its profit. It was like unprecedented in history. So that's the guy who wrote the book Nine-Figure Mindset. And that book Nine-Figure Mindset essentially details how he was able to get to such a point that he managed to sell his company at the highest multiple in history. When we talk about scope clarity, we clearly define the scope and objectives of the due diligence process in alignment with the client's goals, whether it's for a merger, acquisition, investment, partnership. Again, Stephen Covey principle number 2, start with the end in mind. What are you trying to accomplish? Then work your way backwards.
I mean, in any project, the scope of the project needs to be defined before the project begins.
That's right, because sometimes you have teams of engineers working on the non-existing problem. They are trying to solve something, but they didn't think through their end goal, and they end up wasting a lot of time, and they figured they were working on the problem that didn't exist because they just started working without thinking what the end goal of their work is. Information gathering, collecting all relevant financial, operational, legal, regulatory, and strategic information about the target company, ensuring access to accurate and up-to-date data. So when we talk about companies, we can summarize it. We can strip it down to 4 main modules. We have customer module, we have vendor module, we have employee module, and we have government module. If we capture 4 of those bases, that it's like pillars of any company. And then on top of those pillars, we have compliance, we have financial reporting, operations, and compliance. That's the other 3 pillars when it comes to the financial data. So first we have to record and capture information in the financial reports. Then we have to fulfill the compliance requirements with the government, for example, tax compliance. And finally, we must attend to operations. So again, we talk about 4 pillars of any company: customers, vendors, employees, and government. And then from the financial perspective, we have financial reporting, operations, and compliance. When we conduct due diligence, we must attend to all of them, because that's what gives us a fair assessment of the target company, financial and non-financial situation. And I must say that a lot of financial guys are focusing on financial measures, but in accounting, there is also qualitative information, which is as important as quantitative information. If we provide only quantitative information without any disclosures, without any context, it's useless, because the goal is to provide a narrative, to provide a story showcasing the true situation of the business, financial and non-financial factors. Document review. Carefully examining contracts, agreements, financial statements, intellectual property portfolios, legal filings, and other pertinent documents to identify any red flags or hidden issues. Hidden issues, as we were talking about, contingent liabilities, undisclosed liabilities.
I mean, as you were talking about, when you were talking about the qualitative aspect of this work and how important it is to not make mistakes and be mindful of each and every detail. And that makes me remember our company's name as well as the motto, the bee dance. I mean, the bee that finds the nectar source, it has to dance in a very specific pattern. That is the qualitative aspect that the bee follows. I mean, the bee has found the nectar and returned to its nest. That's the quantitative aspect in this regards. And the qualitative aspect is the dance that she does. So, I mean, so as to not make any errors in terms of the location of the source of nectar.
Yeah, and thank you for the beautiful explanation, because it really captures the essence of quantitative and qualitative factors of accounting information. So as Shubham said, that if the bee found a source of honey, if that bee found the source of honey, and then as it was flying to the source of honey, it usually goes through caves and different apertures, and often it can remember not the actual distance, but it remembers its perception of distance based on its visual sight. So then if it comes back and tries to communicate distance, but that distance was not the actual distance, but that was the misperception of distance based on the bee's vision, that's what's known as a density deceived bee. Because after the bees collected the information, and look at the step here, information gathering. So after the bee collected the information, then it misperceived the objective reality of that information, and it did the dance that misinformed the other bees. So they end up in a totally different direction. And as we talked multiple times, start with the end in mind. We don't want a density deceived bee. We want to make sure that we advise clients in such a way that they will truly be able to reach their destination. And as Shubham said, that the main objective of the bee in that bee dance is to communicate the actual and true distance to the source of honey, to that value of to the source of funds, to capture that value. If the bee misperceived the distance, it will miscommunicate that to the other bees. The bees won't end up in the right destination. So we as advisors got to make sure we don't misadvise and misinform clients. And if we're making mistakes in the process, we own those mistakes. We say, I apologize, I misinformed you, let me fix it. One of the worst things that clients want is when the professional or consultant makes a mistake and makes excuses instead of owning that mistake. And because that creates friction, that creates mistrust, that's an assault on the very underpinning of any relationship, which is trust. If my counterpart cannot take responsibility for his actions and own it, then we talk about trust erosion at the very foundation of any relationship. Financial analysis. Conducting a comprehensive financial analysis, including revenue, profitability, cash flow, debt, and asset evaluations. Identify any discrepancies or anomalies that require further investigation. And again, please note this word further investigation in accounting is called subsequent events. When auditors perform audit of the company, they are also required to disclose any subsequent events having bearing on the financial report. The audit is being done by the end, usually, unless it was a different year basis, a fiscal year choice, usually by the end of the calendar year.
Yes.
But imagine the audit was actually done by August 15th of the following year. So if the auditors don't disclose subsequent events that happen between the year end and August 15th, the investors would be misinformed because some significant material events could happen that have a huge bearing on the current condition of the firm. So they can't just take an approach, oh, our audit was based on the transactions for 2022, but if we issue audit in August 15th, 2023, we must disclose subsequent events, even though they happen after the actual end of the audit year in question. So likewise,
if I'm not wrong, maybe the investors can also take it as withholding information and pursue charges against
it would be misleading. Exactly. That's why you have charges against auditors, against accountants, because you have cases when the accountants didn't do their job right, and as a result, investors were misled and suffered serious financial and psychological losses as a result of the situation.
I mean, we also have to account for the psychological.
That's right. So more like moral and psychological damages.
Yeah.
So you see, that's why I highlight this expression here, or anomalies that require further investigation. Usually we follow this formula. There are known knowns, there are known unknowns, and there are unknown unknowns. So just because something didn't come into light yet, perhaps we found something that wasn't necessarily a big red flag, but something was slightly amiss. So the most appropriate thing would be noted down and documented for further reference, because as we go through the due diligence process, we come into contact with additional touch points that illuminate more light on that little cue, and they can either prove or disprove our hypothesis about the seriousness of that flaw. Operational assessment. Evaluating the target company's operations, supply chain, production processes, and organizational structure to uncover inefficiencies, risks, or potential areas of improvement. And we go back to the logistics example. Who does most work day in and day out work for the company? Operations people.
Yes.
And chief of operations would usually manage the team of people who actually implement those strategies on the everyday tactical level. And we were talking about three pillars that pertain to the financial information: financial reporting, operations, and compliance. So here we're talking about operations. So really good CFOs don't just work in the silo, but they work in very close connections with the operations people to make sure they truly understand how the operations work, so that they can come up with truly value-added financial models. Because if this guy sits in his office, but he works in a silo, he doesn't make contact with the operations people, his financial models are going to be a joke. They're going to be detached from reality. Yes. He didn't invest enough work into learning how the operations work. So his model what is his model based on? So we got to make sure that we don't just assess financial models for the strength that we say, oh, it looks like a robust formula. But we must assess, does that formula, does that financial model truly represent the reality of this specific company's application? Maybe the CFO came from some other company and he felt, oh, this is a great financial model.
Yeah.
And he automatically applied it to this company. But then we come and do due diligence work and we realize, well, it's a good formula, it's a good financial model, but it's inappropriate for this other company.
Yes.
So like always measuring the objective reality. Does this financial model represent financial reality? Or maybe it's just good formula in the abstract sense of the word, but not specifically applied to this particular company.
Yes, I mean, firms seeking to pursue due diligence just to uncover inefficiencies or risks that shouldn't be the only goal, since when you do or pursue due diligence, you also find potential areas for improvement. So it's not just about finding inefficiencies or risks, it's about improving your processes so that you can, like you said, when the time comes to actually merge with someone, or someone is looking to acquire from you, you get the value of your firm is at a multiple of higher EBITDA.
Yeah. Thank you for making that crucial point, Shubham, because imagine the due diligence is conducted and due diligence uncovers serious concerns and then the deal is not going through.
Yes.
But wouldn't the due diligence report be still valuable for the target company? That company can take the report and actually say, let's go and implement all of that and make our company more M&A ready. And then sometime later, once we implemented and eliminated those flaws and closed those deficiencies, then the company will be a much more attractive candidate. So it's due diligence, even if the deal doesn't go through, it's a very good investment in getting a report to fix different issues within the company.
Yes.
Or imagine like going back to the B dance. So imagine the B miscommunicated information. And we talked about the book, The Bee Democracy.
Yes.
So like she disadvantaged, she put this beehive at a disadvantage.
Yeah.
She put this beehive at a disadvantage, so she has a more added incentive to calibrate her dance in order to communicate the next time the proper distance to the source of nectar.
If any bee does that, I think the bee is gonna get a beating.
That's it. You may get a serious beating, right?
Yes.
Legal and regulatory compliance, reviewing the target company's compliance with laws, regulations, licenses, permits, and industry standards. Identify any pending legal issues or potential liabilities. So it's called NOCLAR. It's assess compliance against NOCLAR, and NOCLAR stands non-compliance with laws and regulations. And pay attention to this expression here, to this terminology. Pending legal issues, that's the known one, as you were saying, there are known knowns, unknown knowns, and unknown. This is like known pending issues. If there is SB audit going on, and the target company is not disclosing, there is something seriously wrong. But then check out this additional expression, or potential liabilities. That's what we're talking about, contingent. We don't have any lawsuits or audits ongoing now, but the company anticipates that because of the current circumstances, it may be going through lawsuits or audits soon. So just because there are no pending legal actions or pending audits doesn't mean that the company shouldn't disclose any anticipated legal actions or audits.
Yes.
Market and industry analysis. Understanding the target company's position within its market and industry. Assess trends, competitive landscape, customer preferences, and growth opportunities. When we talk about assessing competitive landscape, it's one of the most frequently utilized model is Michael Porter's competitive analysis. Michael Porter was a Harvard professor, and he developed various benchmarks for assessing one's competitive landmarks.
I think you're talking about the 5 forces.
Yes, but Shubham, could you comment on five forces of assessing one's competitive landscape?
I don't have the deep understanding, but I have heard of it. I think you'd be the best person to explain it further.
Yeah, so stripping it to essential, Michael Porter said that the companies must be evaluating things such as competitive advantages. So what are the competitive advantages of this company? And that's what we are doing with our firm here, because when we sell our services, we want to have a clear message to the target audience. But in order to have a clear message and clear value proposition, Michael Porter was big on formulating a concise and clear value proposition based on the company's competitive advantages.
Yes.
Within, because he encouraged companies to consider legal, economic, and technological forces impinging on the company. So changing in laws, changes in economy, changes in technology development factors, like AI is a big thing, ChatGPT. So that's things like that. So we have to assess all that carefully in order to derive the assessment whether this company is truly competitive for merging with this other company. Employee and human resources, analyzing the target company's workforce, organizational culture, management team, and employee contracts. Address potential HR-related risks or integration challenges. So we know, like, people themselves are not assets. We cannot put them as an asset on the balance sheet. But contracts with employees are assets. So if we have some long-term, long-standing contracts with our employees, then they clearly add value to the company, especially with the company is high on SKE. What's SKE? Is it skills, knowledge, and experience. If we have top talent and contracts with the top talent, that will clearly be a value add for the target company. Then we have management team. Is it a good management team, really providing effective management, or is it lousy team? Does the team truly facilitate customer satisfaction? Sometimes you can go to the store and see it on a very primitive level. So you go to the store, you're about to get some supplies for your home repair, for example. And the sales clerk wouldn't even say a word to you. They would be completing the transaction without even saying a word to you. What customer satisfaction are you talking about? And then here by the wall, you can see his manager. His manager is not intervening, not saying anything. So even I don't do any deep assessment of the company, but I'm just watching as a customer. And I'm like, okay, Clark didn't say a word. And his manager is standing here, not intervening, not saying, pretending as if it's okay, normal behavior. And then you look at the stock value of the company, and you see it's slumping, and you're like, and you didn't do any deep analysis, you just made an observation about the customer satisfaction. Then you go to another company, and the customer satisfaction is much higher. You open the stock indices, you see that the stock indices are trending in the right direction. And this is strictly on the customer satisfaction aspect. We're not talking about doing any deep financial analytics or assessments. Very basic. Sometimes we make it too complicated, but some of these things we can see with the naked eye. Is like, how do they treat their customers? If they don't treat their customers right, and managers don't intervene, then see this management team, we have a management team issue, apparently not effective. Doesn't translate into excellent customer service and satisfaction.
And I mean, when it comes to the importance of human resources and employees, and you were, as you were saying before, that they are considered assets. I mean, I have seen companies merge with other companies or acquire other companies just solely on the basis of that they wanted the structure, the organizations, the people. They wanted the people, the management people, because they found that the company's management was the most valuable asset that they saw in that company. So companies are also acquired just on the basis of their people and not necessarily solely based on what conventional asset might be described.
Yeah, and it goes back to that statement, don't bet on a horse, bet on a jockey.
Yes.
So the same thing, people often talk about money and that they need money to do XYZ. But there is no shortage of money on this planet, but there is a shortage of value adding activities.
Yes.
So if we don't produce value added activities, money wouldn't be trickling in. But if we do produce value, we'll inevitably get money. So the same way, if you have a good jockey, a horse can be somewhat subpar, but a good jockey will direct and harness the horse, still produce very decent results. He may not win with a very bad horse, but he still wouldn't be too bad because his experience, he will navigate that even subpar horse pretty well. So it goes back to the importance of the management team, especially turnaround management team who can build value, automations, efficiencies, really drive the company value. Environmental and sustainability factors. Assessing environmental impacts, regulatory compliance, and sustainability practices of the target company. Identify potential environmental liabilities. And people may think, are we talking about all rigs? Are we talking about if there was a BP spill and it has to be remediated? No, it doesn't have to be that dramatic. It doesn't have to be an oil company. We talk about basic waste management policies. Does the company follow basic waste management protocols and policies? So because some people think, oh, environmental, like what environmental things are we assessing here?
It can be as small as using plastic straws.
That's right. Especially in the ESG environment, we talk about environmental, social, and governance aspects. And if we see that the company is not recycling well, I mean, it's basic. We talk about basic things. Risk assessment. And I should add that risk assessment is an integral part of essentially all of the steps we produce: legal, financial, and regulatory. The essence of the due diligence process is assessing risks. That's the underpinning of the entire due diligence process, to assess risks of acquiring a new company. Valuation analysis. Conduct a thorough evaluation of the target company, considering its financial performance, market comparables, and future growth potential. And we just talked about Michael Porter's five forces, like competitive environment of the companies, confidentiality and data security. Ensure that sensitive information and data exchange during due diligence are handled securely, and in compliance with relevant data protection regulations. And we know that cyber is a big issue, especially in COVID. There are so many more cases in ransomware, in cybersecurity threats, especially during COVID. Some people lost employment, and some of them resorted to targeting companies with sensitive information and
extorting ransomware. Become a major issue these days.
Right. So like cybersecurity, like super important right now. That's why it's very advisable for companies to have cybersecurity insurance, because we cannot prevent it. We can only prepare and navigate a course, but we cannot fully prevent it because it's happening all the time. Quality assurance. Implement internal quality control processes to ensure the accuracy and reliability of the due diligence findings and recommendations. Was there any tampering? Perhaps the information wasn't complete enough, a limited sample, based on faulty systems, processes, and procedures. Because internal controls basically boil down to systems, processes, and procedures. That's essentially internal controls. And when we talk about internal control environment, we use a crime framework. C stands for control environment, setting tone at the top, hiring competent people. Then R is for risk assessment. Then I, information monitoring systems. M is monitoring, and E, existing policies and procedures. So it's assessing that crime framework of the company. Ethical considerations. Conduct due diligence with integrity and transparency, adhering to ethical standards and avoiding conflicts of interests. And one of the advantages of hiring CPAs for this work is because CPAs have actually have dual fiduciary duty. On one hand, we have fiduciary duty to our client to protect and defend them. On the other hand, we have fiduciary duty to the government. So we cannot skew it one way or the other. We actually between two fires, so to speak.
Yes.
So it really challenges us to be as objective and transparent as possible.
Yes, I mean, so do our clients. I mean, because of our ethical considerations, we are where we are.
That's right. Timeliness. Execute the due diligence process within a reasonable time frame to
I think
ensure.
you should tell them about DOM timeliness. I mean, there couldn't be a much more perfect example about timeliness. And
Yeah, so one of the cases I worked on, it was a guy who who needed to get transcripts from his CPA, and his CPA didn't know the difference between transcript and the tax returns, and this business owner couldn't get the transcripts for a month.
yeah,
So we met him at a networking event. He asked us if we can help with the tax transcripts, and I said sure. So I told him I can do it within a day. He was impressed because normally the process takes weeks, and I told him that we specialize in tax resolution. We deal with getting transcripts all the time, so we were able to do it within a couple of days, and he was impressed with the lightning speed. And it's
because I mean,
yeah.
we want to form relationships. We
That's
don't
right.
we don't. Our process is not entirely transactional, but we want to have a relationship. We want to nurture their business, and like you said earlier about the value creation cycle, getting back to it, creating value for the client through an elongated process, taking care of their financials, getting them the adequate capital support if they need it, and getting their business to a higher multiple of EBITDA. That's what our goal is here.
That's right. When we talk about quality of accounting information, we have two main factors. It's relevance and faithful representation, and then we have enhancing factors such as understandability, comparability, consistency, and timeliness. I don't care how good somebody is, but if he drags his feet and doesn't produce information, it's not going to benefit the business, because the business and the economic environment moved on. That information ceased being relevant. So we must be timely, because we lose relevance when we provide good quality information but late. It's already lost relevance. It doesn't have value. And as Shubham said, our focus in this firm is to build value each step of the process. We want to get the client to the source of nectar. We want to get the client to honey, to change that bitter taste of stress, anxiety, and replace it with the sweetness of honey and peace of mind that they have from working with the right type of team and the right type of professionals.
Yes, I mean, people really don't have access to ethical services these days, and in such an environment, ever-changing environment, we are able to provide it, and we are happy to do so. And I couldn't have said it better myself.
Yeah, thanks. So compliance with NOCLAR. It's NOCLAR is non-compliance with with laws and regulations. So we check if the company is truly compliant. Yeah, and at that point, if you say compliant with things such as business permits, licenses, sales exemption certificates, sales and use tax, very often overlooked area. I had a guy call me about the use tax case. He was in the tile business, and his company went bankrupt because he didn't know he was supposed to be reporting use tax. And because of the tax debt, his company went bankrupt, and now he's 9 years in after company bankruptcy, still unresolved use tax situation. So things such as businesses may just not know that they have to report not only sales tax but use tax also. And if they take the exemption resale certificate, the responsibility got shifted from the other party to them to collect and remit taxes. FBA outsource CFO service. Why is this relevant? As we said, that the company must be M&A ready. To be ready, they must have proper financial guidance pre-M&A.
Yes.
And the way we can accomplish that is through financial planning and analysis or outsource CFO. We take customized approach, we tailor our planning and budgeting solutions to match the unique needs and goals of each client, ensuring that the strategies put in place are aligned with their specific circumstances.
That means creating a financial model for each company is separate and suited to their needs.
It's like we can say that residual earnings model is generally an excellent model in theory, but we can't say we must use residual earnings model for valuing each company just because in theory it's a very good model. Granular detail. A process involves meticulous attention to detail, allowing us to break down financial plans and budgets into granular components, leading to more accurate forecasts and targeted decision making. We use AI-based software for projections, and we create dashboards that help clients understand the future of their business based on these projections and forecasts. Scenario analysis. We offer sophisticated scenario analysis capabilities that help clients evaluate various possible outcomes, best case scenario, mid case scenario, worst case scenarios, enabling them to make well-informed decisions even in uncertain environments. And because of the time constraint and time benefit analysis, the fundamental question is how to satisfy unlimited wants with limited resources. So time is very limited, and we operate from the insufficient information. So the question is, using this insufficient information we have, how to create the best forecasts operating within the time constraints and insufficiency of information constraints.
Yes, that's where we thrive.
That's right. Forecasting and modeling. Data-driven insights. As mentioned, we use software for forecasting and modeling the future of the company. We are data-centric, leveraging advanced analytics to generate insights that are not only accurate, but also actionable for driving business growth. And Shubham and I were discussing that in order for the insights to have any difference, they must be actionable. Very often we must go to the seminar, to some program, and we gain some valuable information. And we start confusing knowledge information with the application of information. It's called illusion of knowledge. So we also have such dictums as knowledge is power, but that's not really true, because knowledge plus action are power.
Yes.
But if we just acquire knowledge, we are fooling ourselves that we know something and as if we already implemented. But the true experiential knowledge comes only from putting it into practice, to helping other companies, going through some actual case studies so that we can talk from experience, not only from theory. Because if you talk only from theory, we can be false shepherds and tell
Then
people
you can only
yeah.
solve problems in theory,
That's
never
right,
in
yeah.
never in practicality.
Yeah, that's why we want educate people to take action and not just gain insights and stay at the insight level.
Yes.
Predictive analytics. For accounting information to truly be valuable, it must be future focused and predictive in nature. That's one of the subcomponents of relevance, which is one of the two major factors of quality accounting information. We utilize predictive modeling to anticipate future trends and potential challenges, giving clients a competitive edge by enabling them to proactively address emerging opportunities and risks. So if their competitor does not use predictive analytics, but they focus only on QuickBooks and they say, oh, my accountant emails me monthly reports, and that's it. But the business owner is busy, they don't open the report, and even if they open the report, it just report does it have ratios, does it have insights? No, it just balance sheet and income statement. But if we don't provide insights to the clients to inform future decision making, even though that accountant did a check mark, oh, I emailed the reports to the client, but the question is, what does the client do with those reports? Is that information truly actionable? What if, on the other hand, we use software to build dashboards and projections and forecasts and told the clients that based on this current month financial reporting, you can anticipate XYZ trends. And I recommend that you manage your cash in XYZ ways. That's insight, that's actionable insights for the client.
Yeah, in terms of analytics, data analytics, if for example a CPA provides just the report and no suggestions as to what is actionable and what is not, it's called a descriptive analytic. He's just describing that, he's just giving a picture of what's happening, but there is no like you said, there are no insights, and that's where predictive analytics comes into the window. And we are equipped with predictive analytics. We have the software, the know-how to actually check the work of this software as well, and that's what we do, and that's how we advise our clients.
Father of education in America, Dr. Bloom, came up with the hierarchy of cognitive development in children. So he said the very basic step is memorization. We just memorize something. The second level is understanding, is actual understanding that memorized material. The third step is analyzing that material. Then the fourth step is comparing the options, the available options. The fifth step is evaluation, and the sixth step is creating new methods and strategies. So we see, as professionals, we must take that into account and say we don't want to stay at the basic level of memorization. We memorize something or we help client understand it. Our goal is to be so good that we get to the level of 6, or we help them create new strategies that they never tried before. That's a goal, to drive value for them, because if we tell them something they already knew from their experience, what is our value as consultants? Our true value is creating strategies that they haven't utilized before, and they can be truly helpful for them.
Yes.
So going back to Shubham's point about descriptive analytics, and then he talked about predictive analytics. We predict the trends, but then we take it a step further to prescriptive analytics. We prescribe the course of action based on the predictive analytics we performed in step 2. Continuous improvement. Our iterative approach to forecasting and modeling ensures the strategies are constantly refined based on real data and feedback, leading to more reliable forecasts over time. One company we really like here is GitHub. And GitHub, one of the key words for them is iteration. They always experiment and they iterate, they change of course of actions. It's kind of like writing. We write something, we scratch, we write something again, we make it better. So likewise here, we make a hypothesis that a certain course of action will improve the company's efficiencies. But then that hypothesis turned out to be true, and it's having a humility for us as consultants say, that approach didn't work. I'm sorry, let's try a different approach. Being open to the iterative or experimentation processes. Think about like Dr. Langley. Dr. Langley received unprecedented amount of funding from the government to discover an airplane. Despite all of the funding, he failed miserably because he was relying on the government funding and he felt too comfortable in his research. Then we have Brothers Wright who experimented time and time again on their own, no government funding whatsoever. And we know that they were the ones who succeeded in the airplane. And even when the local newspapers wrote this story, the critics say, oh, come on, it wasn't a big deal. It happened only for a very short period of time. We cannot replicate it on the sustainable basis.
Yeah.
But they did it based on that precisely iterative experimentation approach coming from sheer enthusiasm and passion from their work. Even Dr. Langley received like a ton of cash from the government, but that didn't help. Perhaps he didn't have as much passion as these rookie fellows had, and iterated and eventually came up with the airplane in 1903. I used to live in North Carolina, consider North Carolina my home state here. And when you look at the license plates, until this day, license plates in North Carolina says first in flight in honor of Brothers Wright, who they were from Ohio.
Yeah.
But they did complete their first flight in the Outer Banks in the Kitty Hawk area of North Carolina.
Nice fact. I'm not aware of the license plates.
Yeah, first in flight. So our goal here at this firm is to be those trailblazers, to be pioneers for our clients. That they can, by working with us, they can say, we've never heard it before, we never heard that approach. We get them that kind of value-added consulting. Integrated financial planning, holistic view. We offer a comprehensive view of financial planning that integrates various aspects such as revenue, expenses, capital allocation, and risk management, providing a more holistic understanding of the financial landscape. And capital allocation here, when we talk about CapEx and capital investments, it's not only helpful for building the company assets, but from the tax perspective, the tax code significantly incentivizes investment in equipment through things such as depreciation and for tax purposes accelerated depreciation that incentivizes the company to invest in new equipment. Cross-functional alignment. Our integrated approach fosters alignment between different departments within an organization, promoting collaboration and ensuring that financial decisions are in sync with strategic objectives. It goes back to what we were talking about, silos. If there are silos between departments, they are competing between each other, they are not collaborating, then it impacts the value creation of the entire company. So the goal is to help break down the silos. So that may mean talking with the operations, picking up the phone, calling that operations person within the company, so that we do get informed of the operations of the company. Long-term vision. We help clients establish long-term financial plans that span multiple years, facilitating sustainable growth and assisting them in navigating economic fluctuations. So it's a multi-year plan. Even when we talk about personal planning, it's good to plan in terms of 30, 60, 90 days, to plan in quarters, then a year. So then we say, where do you want to be 2 or 3 years from now? That's mid-range planning. Then long-term, 5 to 10 year plan. goes back to start with the end in mind. If I don't know where I'm going, where I would like to go, I am
How will we reach there?
I am groping in darkness.
Yeah.
I am aimless. But if I have my tactical plan 30, 60, 90 day, and I follow OKR, objectives and key reports, and then I have yearly, 2 year, my mid-range plan and long-term plan, I have much more clear objectives, what I'm ultimately trying to achieve. Once I have clear targets, I'm having measures to measure my activity against. And if I'm getting too lazy, then I have people on my team to whom I verbalize my targets who would call me out on not meeting my targets and help me actually meet them. Management and performance reporting, real-time metrics. Our reporting systems provide real-time performance metrics that empower clients with up-to-date insights, enabling timely adjustments and interventions to achieve desired results. So it's real time, it's not outdated from the prior month, but it's real-time metrics based on today's accounting that gets pulled into the software that showcases the information in the real-time metrics. Visual dashboards, that's the point about dashboards that I already discussed. Then actionable insights, we discussed that too, where we see emphasis in this point about operational efficiency, cost management, and overall performance. It is hiring people that can help with the cost auditing. So we work with the partner that can audit all your expenses and find significant cost saving opportunities. Yes, they will charge 50%, but you will still come out with 50% on top.
Yeah.
Overall superiority. And I love this point because we were just talking about different states, and North Carolina saying first in flight. We know what New York says. It's Excelsior, and Excelsior means outstanding or superior. So if you live in these states here that prides itself on the Empire State Building and being superior and outstanding, that's a North Star. So that's a guidepost that we measure against. Because if we don't do it, we were talking about reputational risks in one of the blowbacks of a bad M&A.
Yeah.
Well, the same goes for us as consultants. If you live in this state that bears Excelsior as its emblem, then we bring reputational risk not only to our personal reputation, our firm reputation, but also to the jurisdiction that you represent.
Yes.
Industry expertise.
100%.
Our team comprises seasoned professionals with deep industry knowledge, ensuring that our solutions are not only technically proficient, but also aligned with industry-specific trends and challenges. Client-centric approach. We prioritize understanding a client's unique needs, challenges, and goals, tailoring our services to address their specific requirements, and delivering solutions that truly make a difference, that truly add value. The approach we follow here is called GPS. We tap into client GPS, that stands for goals, passions, and struggles. Once we tap into those, we can really bring value to them, especially solve their struggles, their pain points.
Yes.
Innovation. We continually invest in technology and methodologies to stay ahead of the curve, allowing us to offer cutting-edge solutions that keep our clients at the forefront of financial planning and analysis practices. So as CPAs, we have continuing education requirements of at least 40 hours, but we challenge ourselves to double that every year. The goal for us is at least 80 hours of continuing education so that we stay abreast of all the regulations that we can advise the clients right. Proven track record. A consistent track record of helping clients achieve financial success and navigate complex challenges serves as a testament to the quality and efficacy of FP&A advisory services. One of the clients was on the verge of bankruptcy when the COVID hit, and it was like solid mid-market restaurant. but because of COVID, it was a hair close to bankruptcy. But thankfully, our outsourced CFO services help the client procure financing from the government and different programs such as RRF, Restaurant Revitalization Fund, and now this restaurant is actually making greater revenue than pre-COVID 2019 revenue. That's one of the examples. Tax expertise, tailored tax strategies. A tax expertise is not one size fits all. We understand that each M&A deal is unique, and we craft personalized tax strategies that align with the specific business goals and the intricacies of the transaction. So now there are two types of sales from tax purpose perspective. There is an asset sale, and there is a more common equity sale. Asset sale is more common for very asset-heavy industries, such as that have a lot of commercial or residential real estate. And in that case, the priority is to acquire assets, not so much the ownership stake. In equity sales, the goal is to acquire the ownership stake of that business. And the tax regimes are different for both asset sale and equity sale. We are familiar and have experience with both. Pre-transaction planning. We excel in proactive tax planning before the M&A deal even takes place. By thoroughly assessing your current tax structure, we identify opportunities to optimize tax efficiency and minimize potential liabilities during the transaction. Optimizing deal structures. Leveraging our tax expertise, we guide you in structuring the M&A deal in a way that maximizing tax benefits or tax attributes is another term for that, whether it's through asset or stock acquisitions. And you see, we highlight the two main types, asset or stock or equity acquisitions, mergers or other strategic arrangements. Post-merger integration, we don't limit ourselves with the M&A deal, but also post-merger integration and guiding you through that process. And value preservation, rapid regulatory adaptation, because we make sure we stay on top of the regulatory changes, and strategic negotiation. We bring strategic perspective to negotiations because we can be those data-driven brokers in the transaction, because we can help overcome information asymmetry plaguing the sides of the negotiation table. Once we help to break down information asymmetries by using data-driven insights, that can significantly aid in building transparency and trust that subsequently facilitates the conclusion of the successful concluding of the M&A deal. Client education is a forte. We pride ourselves in educating clients, and this knowledge enables more informed decision making and a higher level of control over the deal's outcome. So it goes back to breaking the information asymmetry. Minimizing disruptions. Our strategies are designed to minimize disruptions to your business operations during the M&A process. This not only helps maintain business continuity, but also preserves value during the transaction. One of the things in the audit report is the clause regarding the entity's going concern, whether the business is sustainable in the long run. So it's minimizing disruptions is one of the factors that enables that kind of business continuity. So from the tax resolution perspective, we make sure if there are any hindrances to the deal based on the outstanding tax burdens that the target company has resolved, we help fix that because of our expertise in tax resolution. Helping with the tax resolution during the deal, it helps with preserving deal value, mitigating legal challenges, comprehensive communication, and compliance with the regulatory framework. We help with document management and deliver measurable results. Then we have legal expertise as a part of our team also that can help with the navigating contract review, because ultimately it will lead to the big contract for the deal, but also during the due diligence process, various contracts with customers, vendors, with different parties. Especially IP and technology expertise during our time and day. Mitigation of post-merger disputes. Synergy with financial and tax teams. Going back to the cross-disciplinary approach. Smooth transition, integration, and scalability, making sure that if we get the model right first, the model will be scalable into much larger context and proportions. We also, since we provide business loans, we can work out the cash for closing the deal, because if it's a smaller deal, it's much easier to acquire a company, but it's a much larger value company. We can secure funding for making this deal possible. We help with strategic loan structuring, coordination with M&A strategy, negotiation support, and financial due diligence.
The loan structuring that we have done in the past as well. I mean, our approval rates have been higher than average. So I think that's a point that people should consider, businesses especially, that we are here for all your capital needs.
And we have multiple lending partners, so we can work it in different angles.
Yes,
We can procure it, if not from one source, then from another.
I think diversifying your capital needs is also a good practice.
Yeah, so here's, like, we come to the end of the presentation, and here's the scannable QR code. Please scan it and fill it out based on your M&A or outsource CFO needs, because we'd love to stay in touch. We'd love to continue this conversation. And when we talk about be dense, what we also imply about that, it's being in the constant rhythm of thought dance. We're not about status quo, but we are agile and adjusting our thoughts and strategies to fit the specific times and the specific facts patterns of our clients.
Yes, and I mean, I'd like to say at the end that filling out this form will allow us to get in touch with you and also understand whatever problem you may be facing and how we can actually help you with that. And as Vasil reiterated, that the Wright brothers, they were passionate about to achieve them. In the same way, we are excited and passionate in helping your business achieve your goals, because that's a win for us and for you as well. Thanks. Also, please do like and subscribe.
That's right. Like, check out YouTube channel. So if you Google it, just Google it, B Dense Tax, it comes up immediately.
Yeah.
But be sure to add tax. Don't just do B Dense. You'll get a lot of different videos. Make sure you B Dense Tax. It will take you. You will see the YouTube channel immediately. Thank you.
I think there's something that fun that we are going to do, since we are passionate about our work, which you'll be able to soon see on the channel. So, we'll keep you posted. Yeah,
you see, like, we make it real with honey too. It's not bee dance, it's not just an abstract concept for us. We do partner with Josh's Bees for honey. And for the first 5 people that sign up for our services, who sign up through our services such as outsource CFO, we'll send a bottle of honey as a thank you for trusting us and working with us.
Yes.
Thank you, guys. We hope you found the presentation useful.